This conference will now be recorded.
Hi again, my name is Mike and I'm the Chief Investment Officer here at Lighthouse Financial. And I'm here for another one of Mike's market updates. So let's get right into it. I'll share my screen for you. Okay, February 23rd, 2022. Here's what we'll talk about today. I'm going to give you a state of the market, and we'll start off with a little detail, some context, an update on this stock market correction that we're experiencing. And then I'll move on and talk about some of the risks that are involved in investing right now. It seems like that's all anyone wants to talk about. So we'll go over those in detail. And then finally, I'll wrap up with a little bit of an economic update and talk about corporate earnings. So here we go. Stock market post-COVID. This chart I trot out every time just to remind us that it wasn't so long ago that we had a 34% bear market correction along with a recession, an economic recession at the beginning of COVID. Since then, you can see that the market's been sort of pretty much trending higher. But most recently, here in early 2022, we've seen about a 12% correction for the S&P 500. This chart shows the closing basis. In other words, it just measures the stock market price at the close of every session. But in order to give you sort of a little more detail here, I'm going to zoom in on the stock market, or S&P 500, just since last July. And I'll show you intraday. So this is every one of these bars that's on this chart, these vertical bars, just show how much the stock market's jumping around in a given day. And I'll point out that the low here, if you can see my cursor circling, the low here on January 24th was 4,222. That was the price on the or the level on the S&P 500. That was the intraday low. And since then, you see we've rallied a little bit, and then here in mid-February, it's fallen off again. And my view is that we are in the process of retesting that low, that 4222 low, which is absolutely normal. Typically, when you get a significant correction, it's because of higher risks to the future investor. So the market is every day trying to sort out, have we priced in enough risk? Have we come down enough? So it's typical, even if this is a resolve very positively, it's typical to see a retest of that low. And for that reason, I don't think we're out of the woods. I certainly, with regard to headlines day to day, I certainly don't think the Russia-Ukraine situation is at an end. And of course, we'll talk about the Federal Reserve and their upcoming meeting in March in terms of providing some clarity. But I'll tell you right now, this so far is what I would call a rather garden variety correction, and it's responding or behaving about like you would expect at the index level. So let's get into the risks, and this risk is falling off the table. It looks like Omicron is in its death throes, and what you're looking at is a chart of 7-day average daily new confirmed COVID cases. So just new cases, incredible numbers, up to 800,000 a day earlier this month, and now we're back down to what we would consider very reasonable levels under 100,000. So it does look like this risk at least is receding. But there's been some news on inflation since our last webinar. Inflation has accelerated, and these are two different measures or indexes of basically retail inflation that affects every consumer. The black line is an estimate by the New York Fed on how quickly prices are rising, and you can see with a 5 handle here, prices are rising about 5% year over year right now, and that's considered fairly elevated. The Federal Reserve's target, by the way, inflation, and they like to use the blue line. That's their preferred measure, core personal consumption expenditures. That one is at 4.85%, so significantly higher than their long-term 2% target. And it's this acceleration here in early 2021 that has convinced the Fed that not only do they have to raise interest rates, but they're going to have to sort of raise them higher than they, I think, expected several months ago. And I suppose I should stop here, just pause a second and explain why it is that higher inflation means that the Fed has to raise interest rates. And the simple reason is because the Fed has kept borrowing rates or lending rates in the economy extremely low for a long time because they want to encourage people to buy homes, buy cars, businesses to go out, take out a loan to hire more employees or to open up a new geography or product line, right? So lending rates are really important, and when you suppress lending rates, keep them really, really low, and encourage all of that demand for loans, you're just going to really explode in inflation higher eventually, right? So eventually, when they see the economy taking off and they see inflation rising, they're supposed to raise lending rates to kind of help moderate things. And they waited, I think, quite a while because they were worried that COVID would come back and you know, maybe more fiercely than it had been, and knock the economy around. But here we are in a situation where the economy is growing nicely, unemployment is extremely low, and wages are rising, and they've got inflation here, as you see, well above their targets. So that means is they're going to have to raise interest rates, and the Fed controls this short-term interest rate called the Fed funds rate, and it's been at zero. This is a chart of futures contract regarding that interest rate. But what this chart tells you is that over the next 12 months, they expect this Fed funds interest rate to go from 0 to 1.7%, just in the next 12 months. So in other words, you know, the bond market and the stock market are trading, or have been trading, in such a way to price in some of the risk of the Fed raising interest rates faster than anyone thought they would several months ago. So that means, you know, what's the terminal rate? How high do they go with their Fed funds interest rate? And then how quickly do they get there? Those two questions are the central debate really among investors presently. So we've already chopped some wood, right? So we've already, this correction means that we've already priced in some slower growth, higher interest rates that are necessary to control inflation in the coming year. But we might not have priced all of it in, and we won't really know until the Federal Reserve shows their hand. And of course, their first meeting is in mid-March, but then they'll meet, you know, periodically after that throughout the year, and we'll see what they do. Another risk in this market right now to investing is the fact that investor sentiment is really weak. This is kind of a show me market, you know, show me that everything's going to be okay before I put a dollar in. So I've labeled this slide sort of, this is a temporary buyer's strike is what this is. The line is real jaggedy, but I'll just explain it real quick. This is a survey of individual investors that AAII does and has done for quite a while. That's the American Association of Independent Investors. And the idea is to figure out who's bullish. What percentage of the respondents are bullish? And the answer is not many, right? 19%. And you can see this chart goes back to include the recession and the bear market in 2008, and the housing crash, or the Great Recession, as they call it. Notice that this line didn't get a whole lot more bearish in that time period than it is now. So we're at the bottom. We're really at the bottom of the range here, and what that means is it can't get any worse. And typically, when this sentiment gauge gets really bad, that's when professional investors sit up and say, oh, okay, maybe this is a good time to invest. So it kind of can be a contrary indicator. So let's see. We can't leave out the Russia-Ukraine event when we're talking about risks. And I want to point out that so far, this doesn't seem to be the type of event that will have a major or even a significant economic impact to us, or even an impact to corporate earnings. In fact, let me just page forward here. This is a quote from FactSet, a FactSet research piece. They're a well-known investment research shop, and they were wondering why, we're not hearing much from U.S. corporations on the impact of, or the likely impact of this crisis with Ukraine and Russia. And they say one possible reason is that combined revenue or sales exposure of all the S&P 500 companies to Russia and Ukraine is about 1%. So, we're not talking about China. We're not talking about, all of Europe. We're just talking about Russia and Ukraine. And we typically do not have a lot of companies that are absolutely dependent on that region of the world to exist or for their growth. So I'll page back. And I just want to make this point as well, that this is not a new thing. This event is just sort of a continuation of Vladimir Putin's long-term strategy to regain some influence in the former Soviet republics. And really, this attempt to regain influence is in direct contravention to NATO's growth in Europe. So I'll point out that back in 2008, Russian forces, using the pretext of Georgian separatists, invaded that country in 2 different places, and that occupation continues. In 2014, Russia not only occupied but just simply annexed the Crimean Peninsula that belonged to Ukraine, and they still have it. And so now we're talking about Eastern Ukraine, and they have now begun rolling tanks into 2 different areas in Eastern Ukraine. And Vladimir Putin says he's going to recognize those as separate and sovereign nations. Of course, that's the pretext now. Look, I know I've heard from clients that the big concern here, well, there's 2 concerns. One is that U.S. troops could find themselves in the middle of a conflict. President Biden did order some U.S. troops to Europe, but he also said that they would not be doing any fighting in Ukraine. So in other words, they're probably deployed to NATO countries like Poland and Germany. So I think there's a low risk of that happening. The second concern is that what if oil prices spike because, or natural gas prices spike because of this event? And it is true that that over the last week or 2, you have seen oil prices and natural gas prices spike higher. But if history is any guide, this will be a short-term spike. And I remind everybody that I talked to about this. It used to be, when I came into this business, we all assumed that the U.S. would be at the mercy of the rest of the world, specifically OPEC, for the rest of our lives in terms of, our energy. And there was this talk of energy independence as a pie in the sky idea. But I mean, with fracking, we have the ability to really supply a lot of our needs now that we didn't expect 10, 15 years ago. And so if this really does get bad, you could expect that U.S. drillers, which are really keeping a cap on drilling activity right now, they'd probably open up the spigot. So I don't think that we're looking at a long-term and very significant spike in oil. Other forces, by the way, beyond this, like strong global demand, are a more important factor and reality at the moment. Okay. So with these risks, inflation, I think, is and the Fed's reaction to it specifically is probably the most significant risk that we are facing as investors in 2022. The Ukraine-Russia event, based on history and the facts I see so far, seem like they are relatively minor concern. And I guess, that makes me think about the fact that when events happen like this, when we're all focused on, well, what's the next Fed meeting going to look like, and are they going to raise interest rates by 25 or 50 basis points, or we're focused on, well, is Russia going to invade half of Ukraine or all of it or just a little bit of it? We get really myopic. We start thinking really short term, and that can be dangerous for investors. Trying to game or guess or try to make these events actionable, like the next Fed meeting, that's a fool's errand, and it can cause a lot of mistakes. So I would just urge you to think long term about these kinds of events. We need to think about the reason that we're investing and what our prospects are over the next, 5 years, not the next month. And to that end, I'll say that, well, I'm going to run the slides back for a second and just take a look at a couple of numbers. At the bottom of this slide, here's the economic backdrop. The economy is supposed to grow 3.5% to 4% this year. That's above trend. That's better than a normal year. Inflation is expected to peak at 5% this year. That's significant, and the Fed does need to tamp it down. And we do need to see inflation peak this year and not continue higher. Consumer spending is supposed to rise about 3.4%. That's a Fed estimate this year. That's pretty strong. And employment, as we know, is very low. The job market's pretty tight. Wages are rising. So that's a pretty good backdrop. Now, of course, you're not going to get the kind of growth in 2022 that you had in 2021. And I'll just give you a graphical representation of this. We'll go to here. This is annual sales and earnings or profits for U.S. companies or S&P 500 companies. And look at 2020 during COVID. You're looking at deeply negative earnings, and in the green there, so negative 12.8%. The rebound from COVID after the shutdowns expired and COVID sort of started to go away a little bit, you can see the 2021 rebound is massive. That is huge. But that's not normal. Those kinds of rates of growth are not sustainable. So we need to have a natural moderation of growth rates. And I don't care whether you're talking about home price growth, auto price growth, earnings, revenue for companies, or just overall economic growth. We need to see a moderation of those rates. And I'm encouraged, this is an estimate from Zacks Investment Research, just polling Wall Street analysts and economists. I'm encouraged that we're looking at profit growth of 10% in each of the next 2 years, well, this year and next. That's pretty encouraging. What I'm saying is that if we stop for a moment and focus not on the next month, but on the next year or two, it looks like to me the backdrop is fairly constructive. And when you have falling stock prices with that kind of a backdrop, what that means is you're just cheapening up asset prices, but they'll continue to grow. Those assets are still viable. So I think we're probably looking at an environment where if we ride out significant volatility patches like we've seen, probably looking at higher stock prices by the end of the year than they are now. I'll be back. I'll show you the disclosures. Those are exciting. I'll be back in about a month to update you again based on what happens at the Fed meeting and how this stock market correction is playing out. And in the meantime, I wish you all the best. Thank you for watching.